Welcome back. AJ, with bond yields surging and stocks sagging, how should our audience be thinking about balancing their portfolios between stocks, bonds, and cash?
I think the 60-40 portfolio hasn't looked this attractive in some time. We actually looked at it in a different way recently. We looked at it from a real yield perspective. So you're taking forward earnings yield, and we actually compared the real yield on your treasury bonds, and we actually seen around 5.5% from a real yielding standpoint on the 60-40. And when we look at that entry point over time, actually going back to about 2018, 2019, when we saw the longest shutdown and government shutdown in history, you had a Fed that was actually tightening around that time, and we also saw some trade tensions. 12 months forward from there, you saw a total return of about 23%. And so if you think about that entry point over time, we saw an average total return of around 21%. Looking back in history over the last 10 to 15 years, it's really attractive right now. And I think when investors are kind of concerned about, well, where can bond yields go from here, we have to think about bonds just outside of the possible capital appreciation, but protection and income. Yields being this attractive haven't been this attractive in a long time. So clients have a great entry point for equities as well, but balancing those two portfolios together, you'll get some of that, downside protection hopefully from your bonds if equities happen to go lower. But in a soft landing scenario, this is a very attractive entry point. We see equities potentially reaching all-time highs. So I think clients should actually think about diversifying and balancing out and taking advantage of, great entry point for yields, but also a great opportunity to get into equities that should only rally from here into 2024.
So in terms of the 60% you're suggesting people be engaged with their portfolios in stocks, what categories should they be looking at?
Well, we really like consumer discretionary right now because it's a great early cycle performer. We haven't really seen those companies really come back to their pre-pandemic levels, but mid-cap equities really outperform in the early part of this cycle. They tend to outperform large caps that first year. So it's very much of a tactical play, but we also like the fact that they have an allocation to industrials, which we see performing in the next cycle.
And within all that, what industries in particular do you think investors ought to be looking at?
Well, I'm going to probably step a little bit outside the mid-caps, but we really like semiconductors right now. And part of that is because there's still a lot of demand that is still left in the market. I know there's a lot of big names out there that have made a splash lately, but there's still a lot of demand out there, especially as the U.S. tries to move some of that production here. And so we think that there's some opportunities in some of the smaller names that probably are being left to the wayside. So that space still has a lot more room to grow. And if you think about the opportunities in AI and some of the growth that's going to require and the technology needs there, I think that's a good entry point for clients to think about in the next cycle.
Thanks for joining us, AJ.
Thanks for having me, Merrill.
Get the best of the day's breaking business news as well as in-depth analysis daily at QZ.com.